Hello, welcome back to another lesson. I hope your day has been going good so far. And without further ado, let's go ahead and jump into it. The primary versus secondary market. So, generally speaking, when most people think about a stock market, they usually think about it as one single place. But there are actually two types of markets that you have to understand. There's a primary market, which is where a security is first created and once sold, and there's also a secondary market, which is the place where the security actually gets traded. So, the difference may seem irrelevant or small, but it's actually a very common question among beginners who want to learn about stocks, and it's also a pretty important thing to understand. So, without further ado, let's go ahead and get into it. So, here's a question. When you open a brokerage app and buy a stock, does the company actually receive your money? For example, you buy a few shares of, I don't know, what's a company, a public company, Apple, okay? Does Apple take that money and use it to build new phones, hire engineers, open smart stores, or anything else to use money for? Right? They're a pretty big business, multi-trillion, right? Usually, no, they don't. In most normal stock trades, you're buying shares from another investor who already owns them. So your money goes to that investor, and their shares move from their account into yours. So you buy a share, and someone sells a share for you. Easy as that. The company is not usually involved in these sorts of transactions. That's because you're trading in something called the secondary market. But there is a situation where the company actually receives the investor's money. And this is called the primary market. The primary market is where a security is created and sold for the first time. The company created the security is called the issuer. For stock, the issuer is a company. For a government bond, the issuer will be the government that is borrowing the money. This is where the issuer actually gets paid. A company might sell new shares because it has to grow. It needs more money to support whatever it's supporting. It doesn't really matter. They just need money to support itself, right? And it could use that money to do thousands of different things. The important phrase here, though, is that it is newly issued. These are not old shares being passed between investors. The company is actually creating and selling new shares, and fresh money is going directly into the company, into the business. This is known as capital, which you probably might already know. The best known example is an IPO. Now, we talked a little bit about this last lesson, so feel free to skip the slide if you already have a good understanding of it, but I'm going to go over it because an IPO is pretty important. Okay? An IPO stands for initial public offering. This is when a private company sells its shares to the public for the first time. Before the IPO, the company is privately owned. If I want to buy shares of a company that's privately owned, I couldn't because it's private. It's owned between private investors. Okay? That usually means the founders, the employees, and the early investors own the business. But then the company decides to go public. Investment banks like JP Morgan, Goldman Sachs, and a bunch of other investment banks help prepare the offering, help prepare the IPO. They help the company decide how many shares to sell, what price to use, and which investors may want to buy them. Once the shares are sold, the company is now publicly traded. And during the IPO, the money from the new shares goes directly into the company. And afterwards, those shares begin trading between ordinary investors, which is the secondary market, which is a great transition for the secondary market, where investors trade between each others. This is what most people are actually talking about when they say they bought or sold a stock. Imagine an investor owns a share and decides that they no longer want it. Investor B wants to buy that share. Investor B sends money to Investor A, and Investor A transfers the money to Investor B. The company does not create a new share, it doesn't participate in the transaction, it's just an investor selling something and another investor buying it. And this happens millions of times across the market. So, when you see stocks trading throughout the day, nearly all of the activity is just between other investors, between someone buying it and someone selling it. That is what's known as the secondary market. So, let's go ahead and put these two ideas. In the primary market, who was selling? Do you know? The company or the government that created the security. In the secondary market, who's selling? Another investor. Who receives the money in the primary market? The issuer does. Who receives the money in the secondary market? The investor who sold the security. A typical primary market example would be an IPO or government selling brand new bonds. A typical secondary market example would be a public company stocks through an exchange. And the timing is also pretty different. Primary markets transactions only happen when new securities are issued. Secondary markets traded happen constantly, all throughout the trading day, right? A primary market, a company only has an IPO once. As soon as it sells all the shares it created, boom, you're now in the secondary market, and all the shares are being traded between investors. So, private market happens once, secondary market is continuous. Now, let's go ahead and show this with an example using Apple. Apple has been publicly traded for decades. Suppose you open a brokerage account today and buy, 5 shares. Where does the money go? It does not normally go to Apple. It goes to another investor who is willing to sell 5 shares at the price you offered. Your brokerage and trading system help you match the order with that seller. This is where brokerages really help come in. So you receive the shares and the seller receives your money. Now, Apple still cares about the stock price and how it actively trades its stock. We'll get to this why in a little bit. But Apple does not receive the money from your specific purchase. This is a key idea. Whenever you buy a share of a stock, Apple does not receive the money. An investor who sells you those shares at a determined price is the person who makes the money. This is a secondary market transaction. So, how can a company actually raise money in a primary market or via an IPO? Let's say a company releases 4 million new shares during its IPO. Each share is sold for $25. To find the amount raised, we multiply 4 million by 25. This gives us $100 million. And before the fees, the company has raised $100 million of fresh capital that it can use whatever it wants to. Hire workers, conduct research, expand operations, development, pay off debt, whatever it wants to do. It's their money. It's their capital. This only works because the shares are new and the company is the one selling them. If those 4 million shares are later traded between investors, the company does not keep raising another $100 million every time they change hands. It only receives the money when it issued them, okay? You have to get the idea that whenever you're trading a stock, the company doesn't get anything. I've already said this last time, but it's a pretty important thing to understand. So, at this point, you might be wondering why secondary market even matters to the company at all, right? They're not making any money from it, right? So, if they don't receive any money, why should we care? The answer is something I talked about. It's called liquidity. Liquidity basically means how easily you can buy or sell something. Imagine a company asks you to invest in its IPO, but there's one catch. Once you buy shares, you can never sell them. Most people will be much less willing to invest, right? Because why would I buy a company if I'm not willing to exit it and make my money, right? No one would do that. So a secondary market gives you a way to sell your shares later. Because investors know they can get out later, they're more comfortable getting in now during the IPO. That makes it very easier for companies to finance investors when they first issue shares. So even though the secondary market doesn't necessarily give the company actual money, right, it helps them make the primary market possible, right? It indirectly helps them make not really indirectly, directly helps them make money through the primary market because it allows investors a way out via the secondary market. There's one term that might be a little bit confusing, and it's called the secondary offering. A secondary offering happens when a company that's already public selling new shares. So even though it has the word secondary in its name, it can still be a primary transaction. The reason is because the company is creating and selling new shares, and the company is receiving the money. The word secondary basically just means that it's later offering. The IPO is the initial, and this is not the secondary. They came up with the names. I'm not sure why. Don't ask me. Okay. So, if two investors trade shares that already exist, the company does not raise new money. So, like I said, it's word secondary, just secondary. Okay. So basically, if I'm already a public company like Apple, and I decide I want to issue out even more shares, then people who buy those new shares, I keep the money for myself. The Apple gets the money itself, because the Apple issued out those new shares. So, let's go ahead and look at the big takeaway. First, the primary market is where new transactions are created and sold. The company or government issuing them receives the money. Second, the secondary market is where existing securities are already traded between investors. That normally usually goes to the seller, the person who's selling the shares to the investor, not to the company. And then also, finally, both markets heavily depend on each other. Investors are willing to purchase new shares because they know they will be able to exit out in the secondary market. That ability creates liquidity. And that liquidity makes it easier for businesses to raise capital. It makes it easier for people to buy and sell shares. That's what liquidity is. So, Whenever you look at a transaction, ask these two simple questions. Is the security new or does it not exist? Or, and who is receiving the money? And once you can answer those questions, the difference between primary and secondary markets is pretty easy. That's it. So I hope you learned some news from this lesson, and I hope you have a great day, and I'll see you in the next one. Bye-bye.